तो आज के वीडियो में हम लोग करेंगे चैप्टर 17 का क्विज एंड ये क्विज आपका फाइनेंशियल अकाउंटिंग सब्जेक्ट से है। ये सारे क्वेश्चन स्टडी हब का है। सो एज यू नो, कॉपलान एंड बीपीपी आर नो longer approved content of ACCA because ACCA itself has launched their material study hub. So try to use this material in your preparation phase as well. So you can use Copla and BP as well, no problem, but still as the study hub resources are approved content, so try to use it in your preparation phase as well. So previously we have solved up to chapter 16. In today's video we will be going to solve chapter 17 quiz. And this one is from the consolidations. So first question is, number of different terms are used for investment by one business in another. So which of the following statement is false? So question is asking regarding out of these four, which one is wrong? So first one is, a group can only exist if there is parent subsidiary relationship. Yes, in order to have prepare consolidation or create a group relationship, there should be a parent subsidiary relationship. So this is true. Second, a subsidiary need not to be a company. Basically, yes, this is also true. A subsidiary can be any entity, but parents should have a control over it, right? So again, this is true. And the third, trade investment is not a subsidiary or an associate. Yes, this one is also correct. So last is, your parent control a subsidiary if it receives fixed return on its investment. See, fixed return are not compulsory. So this one is incorrect. Now question number second. Pembroke Company purchased an 80% of shareholding in Saunders Food Company on 1st January 20x5. In the consolidated financial statement of Pembroke Group, which is the correct formula for calculating the profit for the year attributable to the owner of Pembroke. So while we are preparing the consolidated financial statement, the consolidated profit, the group profit we have calculated, is proportionate between the parent and the non-controlling interest. So we need to deduct the non-controlling interest part in order to arrive at the profit which is attributable to the parent one. So first formula is group profit for the year plus non-controlling interest share. No, it should not be added, rather than it should be subtracted, because as I said, this profit is for the both parent and the NCI. So we should remove NCI portions to get the what the profit is attributable to the parent one. That's why it's incorrect. Now B is correct one, which is exactly what I said. And C is only representing the group profit, which is incorrect again. So Prem profit for the year, no. In consolidation, we add up both statement of profit or loss of the both entity. So we just can't take the parent profit and add non-controlling interest shares. So B is right one here. Third, British Bury Company acquired 75% of share capital of Simbridge Company on 1st Jan 20x8. Both company make up their financial statement to 30 June. See, for the consolidation one, it's very important to look into the dates of acquisition and the year end. Why? Because it could be your mid-year acquisition case. Like in these questions, the year end is 30 June, but the acquisition has taken place on 1st Jan. So that means it has only been 6 months of acquisition take place. So it is a mid-year acquisition case. So Prestbury Company sold goods with a sales revenue of 120,000 to the Slimbridge Company over the year to 30 June 20x8 at the markup of 20%, and none of these goods were in the inventory at the year end. Alright. Okay. So Slimbridge Company incomes and expenses were spread evenly over the year to the 30 June 20x8, and it made a profit for the year to 30 June 20x8 of 180,000. Which one of the statement is true? So, alright, the first one is intra-group sales of 120,000 should be deducted when calculating revenue in the consolidated financial statement. See, the question says that income and expense will spread evenly, right? So, we just can't show we deduct 120. We need to proportion this amount because it has only been 6 months that this acquisition has been taken place. That's why it's incorrect. The pop is 20,000 because no, there will be no pop. Why? Because the question clearly says there is no goods remaining in the inventory. When do we calculate the pop? When there is intercompany sales and after the sales the goods is remaining in the inventory. In that case, we calculate the pop. But all the goods has been sold outside. That means profit has been realized. So there is no need to calculate the pop. Now third, non-controlling interest shares group profit for the year is 20 to 500. So what we need to do is the question has provided the profit. I think group profit. Just a second. 180,000. So 180,000 is the profit. Then we need to proportionate it for the 6 month. And what is the NCI percentage? It's 25. So yeah, NCI percentage is 20 to 500. That's correct one. Alright, then Slimbis company pre-acquisition profit is deducted from the profit for the year shown in the consolidated SPL to work out pre-company and NCI share. No. So we didn't deduct the Slimbis pre-acquisition profit. Basically, we deduct it. We deduct this pre-acquisition profit from the goodwill from acquisition, right? While calculation of goodwill at acquisitions, right? But while we didn't just deduct this profit to show it in the consolidated SPL. We take the whole figure. If it is a mid-year acquisition, then we used to proportionate. But yes, we didn't deduct here in the P&L, but we used to deduct this pre-acquisition profit from the goodwill while calculating the goodwill at acquisition. Now next is Thomas owns 65% of shares in the Drew and Drew owns Thomas 5,000. Thomas has receivable of 300,000 and Drew has receivable of 130,000. What are the consolidated receivable for Thomas? Okay, so obviously the control has been taken place between these two companies, so there will be parent and subsidiary relationships. So we need to add each item of P&L and the balance sheet. So these two need to be added. That 300 plus 130,000 will give us 430,000. Then we need to deduct 5,000, which will give us 425,000. Why we are deducting? Because it's an intra-group company transaction that we need to remove. Next we have which two of the following item will be eliminated on consolidation. Fine. Sales from the parent company to an associate. See, associate is not a part of the group, so that's why it's not need to be removed. B. Pre-acquisition return earning of subsidiary. Yes, we used to remove this while calculation of goodwill. So amount owed by subsidiary to the parent. Yes, any intra-company transaction should be removed. Last, non-current asset held by subsidiary at acquisition. No, we didn't remove. In fact, we added it with the parent NCA. So only B and C used to removed in consolidation. So we are done with this chapter as well. In next video, we will be completing our last chapter, and that's a chapter 18. So stay tuned.